Good afternoon. We'd like to thank you for joining the Gabelli Fund's live webcast series. Today, we're excited to be joined by Kevin Dreyer, co-CIO of Value and portfolio manager of the Gabelli ESG Fund, as well as Christina Alfandary, managing director of ESG and sustainable investing, to discuss opportunities in ESG and sustainable investing. I'd now like to turn the call over to Christina.
Good afternoon. Thank you, Chris. There are an awful lot of news and articles around ESG investing today, so we feel that this webinar is timely. We'd like to walk through how we look at opportunities related to ESG and sustainable investing here at Gabelli Asset Management, talk about the growing interest in the area, and cover some exciting areas we're currently investing in. We'll also like to ultimately let the audience understand for themselves why ESG matters. And of course, we will talk about company specifics. So just as a brief background, first, Gabelli Asset Management, which is the fund business of GAMCO Asset Management, was founded in 1977 by Mary Gabelli. We manage roughly $39 billion, 250 employees, and are located in Rye, New York. We're an active fundamental investment manager known for our value style investing. We also manage growth portfolios, and most of all, we're known for our deep, intense research on companies and industries. Less well known is our experience in the responsible investing space, which now is over 30 years, managing just around $700 million. Our history and commitment in this area started back in 1987, managing institutional portfolios for clients. At this time, negative screening was primarily used for portfolios to remove certain risks, whether it be to alcohol or tobacco, for example. We launched our current ESG fund back in 2007. As the space has evolved and companies put out more information, we've been able to incorporate more ESG integration while focusing on, of course, investment opportunities around sustainability. So why is everyone talking about ESG and sustainable investing now? It has to do with the fact that the global population is set to increase to nearly 10 billion by 2050, but we will need 30% more water, 45% more energy, and 50% more food by 2035 and 2040 to sustain that population growth. This puts large demand and impacts the environment as well as society in a way that the world currently has not yet experienced. So as this impact becomes more noticeable, we are all seeing things like, whether it be wildfires on some of the hottest years on record, and that's one of the reasons why there's a lot of focus right now on ESG investing and sustainability. So while awareness grows, it's important to also understand what kind of investors and who specifically is very interested in this area. On this chart, you'll see that around 88% of millennials are interested in impact and ESG investing. Over 60% of females and Generation X are as well. The interest really comes from the fact that this next generation will inherit some of these challenges related to sustainability, and they would like to see capital mobilized to solve some of these important issues. We see different solutions needed across many areas, including water, energy, food, health, and also waste and plastics. If we're to see the world's population grow until 2050, we want to make sure capital flows into innovation around solving some of these challenges. So ESG investing is not about just looking at the sustainable solutions. It's also looking at current businesses and how they're managing ESG issues related to their own business, regardless of what industry that they're in. So as investors and as research analysts, we look to understand how companies are managing certain ESG risks relevant to their business and connecting this to their financial impact. On this slide, you'll see a number of ESG factors, and there are many to look at across the environmental, social, and governance pillar. As investors, we use our industry expertise to look at what are the most material issues. For example, water and energy may be most relevant for a consumer staples company, whereas privacy, data security might be most relevant for a financial institution or a technology company. Among ESG issues, governance historically is an area that has gotten more attention. It's an area that we at Gabelli have focused on since the 1980s. In 1988, our firm created a Magna Carta for shareholder rights, outlining what we were for and what we are opposed to. As an active manager, we have also always voted our own proxy. One area to start with in ESG investing, we'd like to discuss an important area around water. Hardly a year goes by these days now where there isn't some news of a water-related crisis around the world. These images remind us of the importance of clean water availability for society and for economic growth. I'd like to now hand it over to Kevin Dreyer, who will talk and dive into the dynamics of water.
Thank you, Christina. So again, I'm Kevin Dreyer. I'm a portfolio manager on the Gabelli ESG Fund, as well as co-CIO of the value team. So when we look at water, just to give a specific case study example here, and I note that this is the kind of in-depth company and industry research that we do for all of our investments here at Gabelli. But when we look at water, there are some key growth drivers. One is population growth and urban migration and the pressure that that's putting on our resources. We have some very old infrastructure, especially in the areas of sanitation and distribution of water. As a result, we're looking at increased regulation and how that relates to both pollution as well as water availability. And then finally, global warming is continuing to contribute to these imbalances. When we look at water as a market, it's about $500 billion currently, growing mid-single digits. Of that, utilities are spending about $190 billion per year, with $80 billion spent on services, about 40 for pipes, 30 billion for pumps and valves, and 40 billion for other equipment. Now, there are many companies that are involved in some aspect of the water market, but Xylem is one of the largest pure plays that is currently working to address a number of issues related to water. Some of their products are shown here on this slide. So first, just to review the capitalization, there are 180 million shares. Stock is about 76 for just under a 14 billion market cap. They have 2 billion in net debt for almost a 16 billion total enterprise value. So what does Xylem do? Well, first of all, they were spun off from IT&T in 2011. They are a global leader in the design, manufacturing, and application of highly engineered technologies for the transportation, treatment, and testing of water. They're also going to benefit not only from increased spending on water-related infrastructure globally, but also from synergies and revenue growth from some of their recent acquisitions. Of those, they did HYPACK, which is basically a survey data and software company in 2015. They bought Census, a smart meter company, for $1.7 billion in 2016, and Pure Technologies, which does smart infrastructure assessment for $400 million in 2017. So all of that, they're getting the more technologically advanced areas within water that's accelerating the revenue growth. From an ESG perspective, they are AAA rated due to both their focus on water and wastewater solutions, as well as best governance practices, dating back to that spinoff in 2011. Now, as investors, when we look at it on a private market value basis, we value their water infrastructure business at about $7.7 billion, Applied Water at about $4 billion, and Census at about $5.4 billion. We back that out the net debt, and we come up with a value of about $96 per share for the company in 2021. So moving on to another theme that we focused on for a long time, health and wellness. We all know that obesity is a problem not only in the US but globally, and as a result, people are trying to combat this by eating better and paying more attention to what we all put in our bodies. There are a number of trends going on within the food and beverage industry, including improving nutritional profiles of products, reducing sugar content, new sources of protein such as plant-based, looking at the antibiotics we use in the food supply, as well as the packaging and plastics that are used for all of these foods. So one company that's just a great health and wellness play that we do own in the fund is called Hain Celestial Group. The ticker is HAIN. Their motto is a healthier way of life. In addition to being health and wellness focused, they have a number of ESG factors in their food production that they focus on, including raw material sourcing, supply chain, their water and wastewater usage, their energy usage, as they're trying to do what they can to combat climate change, as well as their packaging. So Hain has 104 million shares. The stock's at about 26 for a 2.8 billion market cap. So it's a small cap, 290 million of net debt and 19 million of other assets for just over a 3 billion total enterprise value. So as I said, Hain is a pure play health and wellness focused food and personal care company. They do have new management. CEO Mark Schiller brings in a very credible consumer packaged goods management experience. He took over for the founder, Irwin Simon, who stepped down recently. Schiller and his management team are highly incentivized to increase shareholder value through their own stock ownership in the company and incentive awards that can come to them with hitting certain share price thresholds. They've got a very credible turnaround plan to eliminate unprofitable SKUs, reinvest in marketing, and increase margins. And from an ESG perspective, they're A-rated due to their health and wellness focus, as well as their commitment to sustainable sourcing for palm oil, as well as other commodities. On a private market value basis, we value Hain's U.S. business at about 1.8 billion, the UK at about $1 billion, rest of the world at about 500 million. And that gives us a total value of $32 per share in 2022. So that's the main overview of the fund and what we do. The various classes and their tickers are shown on this slide. And the top 10 holdings are now shown here. We focused on a few areas, but we do own companies in a wide variety of industries. Just to give a little color on some of these, in terms of the healthy eating area, we do have a number of investments in addition to Hain, Danone, which is a pure play health and wellness company, Nestle, the global leader in health, wellness, and nutrition, Conagra Brands, which recently bought Pinnacle Foods, which gave them the Bird's Eye vegetable brand, as well as Gardein. We note Sony as a top holding here, which is known for both their electronics and entertainment divisions. They're also an ESG leader when it comes to supply chain issues. NextEra Energy, which is a utility and one of the leaders in renewable energy in the country. C&H Industrial, which is an equipment company. They have a decarbonization strategy that's best in class. Another water play with Watts Water. Bristol Myers Squibb, a healthcare company. They're buying Celgene. They have a lot of advanced products treating cancer. And finally, Alphabet, which gets high ESG marks for their human capital development, as well as privacy and data security.
Great. Thanks, Kevin. As a reminder, you can enter your questions in the Q&A box at the bottom of your screen. As we wait for questions to come through, we had a few which were submitted prior to today's call. The first one comes from George in Florida, and he wants to know, how is exclusionary screening different from ESG incorporation?
I'd be happy to take that. So historically, as I mentioned, responsible investing predominantly used negative screening to rule out certain areas that investors didn't want exposure to. ESG integration is really more forward-looking in terms of understanding how a company is addressing certain energy transitions that the world will be experiencing, how if they're a material user of water, how are they both metricing and managing their water use. So in that regard, it is more forward-looking in terms of their planning and their ability to mitigate some of the risks that their industry and their businesses are exposed to as the world's population grows and we come under increasing resource constraints.
Great. The next question comes from Rebecca in New Hampshire. She says she's concerned with climate change. Should she be looking at socially responsible investing or an ESG strategy?
There are a lot of strategies out there. My perspective is if someone's highly concerned with climate change, they could look at responsible investing as a broad topic, but they really need to look at the specific product. There are products that are fossil fuel free and ESG, and use ESG integration to look at how companies are managing around the environment. Our fund is fossil fuel free. And then there are other, surprisingly, there are some, quote, ESG indices which are viewed or marketed as sustainable, but they're not fossil fuel free. So it really depends upon, it's a product by product sort of search, and I would encourage her to look at each product carefully.
Another one here in regards to Alphabet, given some of the recent antitrust and concerns surrounding Google, can you give some thought into the investment process of Alphabet?
Yes, great question, and certainly one that we look at. And I note that there are kind of two lenses through which we look at things here. There's the ESG perspective, and then there's the pure investment perspective. And sometimes controversy can lead to opportunity in terms of a stock price that gives us a margin of safety, we think, where we can buy a great company at a very good price. And that's really the case with Google, that when we bought it earlier this year, because of some of these regulatory or antitrust concerns about the company, allowed us to buy the company where we think its search business was being unappreciated by the market and have potentially very big upside with some of their other bets if any of them work out.
And then one more here from Heidi in Minnesota, and she wants to know, is integrating ESG factors into a portfolio worth it?
Well, we are obviously biased, but we would definitely say yes. And that's that, when we're looking at a company or an industry, even aside from this particular product, at Gabelli, we're long-term investors. So first and foremost, we're looking for really excellent businesses that are, by their very definition, sustainable. And we can own them for a very long time for clients, and we have a history of doing that through low turnover. I think what the ESG integration really does for us is it takes certain risks and opportunities that maybe through a typical financial analysis one might miss, and helps us to factor those in so that we're really looking at companies that are really levered towards growing areas of the economy, like we said, water, health and wellness, renewable energy, certain other areas like that. So I think that when you are incorporating ESG factors, you're just naturally setting yourself up, from an investment standpoint, into fruitful areas, not just over the next year or so, but over the next 5-10 years and beyond that.
Great. That looks like all the questions we have for today. I'd like to thank Kevin and Christina for your time, and we'd like to thank everyone for joining the live webcast today.
Investors should carefully consider the investment objectives, risk, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 1-800-GABELLI or visit www.gabelli.com.